The market is very sensitive to events like that happening, and so sometimes it's nice to hold assets that are more predictable in terms of their return profile.
Hey, it's Kevin Amolsch, Pine Financial Group, where we work together so you succeed. Hey, wherever you found the video, do us a favor, hit like, hit subscribe, leave us some comments. We have maybe a little bit more of a controversial topic here, so let us know what you think in the comments. We're trying to build a channel to help more real estate investors just like you. I say a little bit controversial, Monica, because, oh, by the way, I have Monica Ho with me today, our Director of Capital Markets, so she's a whiz when it comes to investments. That's why I asked her to join me here. I want to talk, Monica, about diversification, and we're going to dig and poke at maybe a little bit at the stock market. So tell us, we'll start here. What is diversification, and why is that important to keep a portfolio safe?
Yeah, so diversification is important because each asset class has its own return profile and risk profile. So diversification means you're allocating your portfolio and assets amongst asset classes to ensure that the target weighted return meets your risk appetite. So for example, the stock market can be very volatile and also correlated depending on the macroeconomic environment. Diversifying your asset classes in your portfolio is important in case there's, a big event like COVID, or the Fed report comes out and the jobs report is really positive. The market is very sensitive to events like that happening, and so sometimes it's nice to hold assets that are more predictable in terms of their return profile.
So a little mix of different types of assets. So if we're going to focus in on the stock market for just a second, how do we diversify within the stock market?
Yeah, so, if you're really passionate about specific companies or technologies like Apple, for example, you might hold Apple-specific stock. But if you're not so sure about making bets on specific companies and their performance, you can invest in an index fund. I personally am not a day trader. I don't know that much about earnings releases, and I don't follow all of that news. So I just personally invest in an index fund.
I do the same thing. Okay, so if we want to diversify outside of Wall Street and maybe get into Main Street, which I think is true diversification, I think you should have exposure to both. I think you agree. What are some ways that we could diversify outside of Wall Street?
Yeah, so holding real assets like real estate, for example, is a great way to diversify and make sure that your investments aren't totally correlated with each other. I think the issue with diversifying sometimes is the barrier to entry. Say, for example, you're in your 20s and you don't necessarily have enough savings to buy a house and invest in a property. You can invest in a real estate fund, or in the case of Pine Financial Group, a real estate debt fund. Now, there are different barriers to entry depending on the fund structure in terms of accreditation or non-accreditation. But I think that, looking at the asset classes and seeing if they're correlated or not can help you make more informed decisions.
So why would someone want to invest in a debt fund? I've heard that term. Maybe explain what that is, and why would somebody even consider that?
Yeah, so in terms of investing in real estate debt, the benefits include the predictability of the returns. For example, our loans and our funds all offer fixed interest rates. So you generally know what your annual return is going to be compared to, investing in an index fund where your return could be 0 or 20% in a year. You don't really know for sure. When you're investing in a manager that's originating first lien loans, that offers security within the capital stack. So, it's not the most high returning investment option, but it's a safer option in terms of the position within the capital stack.
You are so generous, You said 0 to 20% possible returns. It could go negative.
Yes, that's true.
And it quite often does.
Yes. Not if you hold it over a long period of time, hopefully.
All right, I want to just close with this. A lot of the viewers probably have retirement accounts. So there's some 401ks, some IRAs. Most of the time, especially with the 401ks, you're forced into whatever they offer, their menu you have to choose from. Real estate is not on that menu.
Right.
It's mutual funds, bonds, that kind of thing. So do most people already have exposure into Wall Street, and should they be looking at other assets classes with their other assets?
Yeah, that's a really good point. I think, oftentimes you're looking at what you can trade in and out of when you're balancing your portfolio. I think it's important to consider your retirement funds as well. As you mentioned, a lot of those target funds Allocate between stocks and bonds depending on your age and your target retirement age. And it'll rebalance your exposure to bonds versus stocks depending on your risk appetite. So it's important in considering what you can control outside of that 401k or IRA account. For example, you can invest in our funds via self-directed IRA and have a little more control in terms of what asset classes you're investing in. But it's important to remain balanced all across your portfolio.
Yeah, so if you already have your investments in a 401k in the stock market, you might want to consider other assets, real estate, private debt, like you talked about, other funds, PPMs, private placement memorandums, or even private equity. There's lots of different options out there, so please consider those to get true diversification. Any final words before we close out?
No, I think this is great.
Hopefully this video helped you. Hopefully you leave a comment, even if you totally disagree with us. I'd love to hear it. You could get more information about Pine Financial Group at pinefinancialgroup.com.